Question number 2. Eagle Limited reported a profit of 77 lakhs after 30% tax for the financial year 2011 and 12. An analysis of the accounts revealed that income included extraordinary items of 8 lakhs and an extraordinary loss of rupees 10 lakh. Okay, so there is an extraordinary income and extraordinary loss. The existing operations, except for the extraordinary items, are expected to continue in the future. Okay, so the existing operations, except for the extraordinary items, are expected to continue in the future. In addition, the results of the launch of a new product are expected to be as follows. Okay, so there is sales, material cost, labor cost, fixed cost. So you can find out the profit of this new product. Okay, you are required to calculate the value of business given that capitalization rate is 14% and also determine market price per equity share, that is MPS, with Eagle Limited's share capital being comprised of 1 lakh 13% preference shares of rupees 100 each and 50 lakh equity shares of rupees 10 each, and the P ratio being 10 times. Okay, so there are two things that we need to calculate. One is value of the business, and the other is market price per equity share. Right? Okay, we will start solving the problem. Question number 2. Computation of business value. Business value. First bit. So, what is the first input that we have? It is profit of 77 lakhs after 30% tax. That is profit after tax. Profit after tax. This is 77 lakhs. Now tax rate is 30%. So profit before tax. This is 77 by 1 minus 30%. That is 77 by 70%. That is 110. Right? Next, it is said that existing operations except for extraordinary items are expected to continue in the future. That means extraordinary items we need to eliminate from profit computation. So what are the extraordinary items? It is extraordinary income of 8 lakhs and extraordinary loss of 10 lakhs. So minus extraordinary income plus extraordinary loss minus 8 plus 10, right? Because we already included extraordinary income in this profit before tax, so we are now reducing it, and we deducted extraordinary loss from this profit before tax, so now we are adding back. Okay, this would be 110 minus 8 plus 10. That means 110 minus 8 is 102 plus 10, that is 112. Now we will include new product details. New product performance. Sales minus material cost, labor cost, fixed cost. Sales minus material cost, labor cost, fixed cost. What is sales? 70, material cost 20, labor cost 12, and fixed cost is 10. 70, 20, 12, 10. 70, 20, 12, and 10. Right? Rupees lakhs. Okay. What will be the value? it is 70 minus 20, 50, 50 minus 12, that is 38, 38 minus 10, that is 28. So profit in new product business will be 28, right? Now, future maintainable profit before tax, it will be 112 plus 28, that is 140, right? Minus tax at 30%. So 30% on 140 will be 42. So future maintainable profit after tax, it is 140 minus 42, that means 98. Now, so this is the profit that is expected to be generated every year by the business, and this includes new product business as well, right? We have excluded extraordinary income and extraordinary loss from the calculation, right? So what is the capitalization factor? Capitalization rate is 14%. So future maintainable profits after tax divided by capitalization rate will give us business value. Generally, if you see, future maintainable profit is nothing but business value into capitalization rate. So if we bring this down here, then we'll get business value, right? Value of business is 98 by 14%, that is 700. Therefore value of business is rupees 700 lakhs. So with this, first bit is done. Now second bit. Determine the market price per equity share, that is MPS, with Eagle Limited share capital being comprised of 1 lakh 13% preference shares of rupees 100 each and 50 lakh equity shares of rupees 10 each, and the PE ratio being 10 times. So we have future maintainable profits after tax. Now, this is to be distributed between preference shareholders and equity shareholders, right? So, preference shareholders, it will be in the form of preference dividend, and only then the residual will be shared by equity shareholders. This residual is nothing but earnings available to equity shareholders, right? So now we will compute earnings available to equity shareholders and divide it by number of units to get earnings per share, earnings per share, and since PE is given, we will multiply this earnings per share by PE to get market price per share. Into PE, we will get market price per share. See, PE is price by earnings, right? This is PE ratio. So when earnings goes here to the right, then we will get price. Therefore price is PE ratio into earnings, right? So that is how we get MPS. Okay, so now we will start solving second bit. Number 2, bit number 2, computation of market price per equity share. What is future maintainable profits after tax? See first bit. Okay, it is 98 lakhs, right? To this we need to subtract preference dividend. This is 1 lakh into 100 each. That is 100 lakhs is the face value on that 13%. So this is 13% of 1 lakh into rupees 100. That means 13% on 100 lakhs. That is 13 lakhs. We get earnings available to equity holders. That is 98 minus 13 is 85 lakhs divided by number of equity shares. It is 50 lakh. 50 lakh. So what is earnings per share? It is 85 by 50. 85 by 50. That is 1.7. What is PE? Into PE ratio. It is 10. So market price per equity share is 1.7 into 10. That is 17. Therefore market price per equity share is rupees 17. So this is second bit and this is the solution to the problem.